Good evening and a warm welcome to You and Your Money. I'm Bryan Hirsch, and this evening we're focusing on the investment world. It's been quite remarkable how global markets have remained almost flat over the first 5 months of the year. This is despite the events of April, particularly the turmoil on Liberation Day following Trump's tariff announcement and his subsequent reversal. Although US markets are currently only about 5% below their highs at the end of January, April was an especially stressful month for investors. However, those who stayed the course have now seen their patience rewarded me. And joining me this evening from the Zoom room in Cape Town is Henry Biddlecombe, investment analyst from Anchor Capital. Henry, good to have you on the program. And Henry, one quick question before we go into business. Enjoying fatherhood?
Very much, Bryan. It's the best thing I've ever done, and you did warn me.
I did tell you how wonderful it is. Next time, bring him on. But first question to you. On our recent programs, Henry, you've expressed now concern about the market's euphoria and your expectations of a correction. Well, we've had this, and I hope we find you in a slightly more bullish mood today, and I'd really appreciate to hear your current thoughts.
Well, geez, Bryan, I've barely had time to be bullish. The market's bounced right back, hasn't it? I was becoming. Let's just talk about index value. So the S&P 500 was sitting at 6,100. That put it at historically elevated valuations. And I think what I'd been telling you for some time was that the market just wasn't discounting the possibility of any hiccups. And that always makes me a little uneasy. When Trump announced the trade tariffs on China and the rest of the world, the market woke up to the economic reality and priced that in very quickly. The S&P fell to 5,000. And a couple of weeks later, here we are back at 6,000. So am I bullish now? No. Was I bullish at 5,000? Yes, for about 5 seconds.
It was quite a V approach. But Henry, what are the likely consequences if the US interest rates remain elevated and trade tensions escalate once again? Because we've got all these dates. I mean, Trump's latest story about the tariffs on steel. We've got the 9th of July as another date. I mean, how do you see this developing?
Look, the market is always pricing in a picture. And we need to try and determine, is that picture realistic or not? And what I can tell you is that, I guess the latest anagram is probably a good one, the taco trade. Have you heard of the taco trade, Bryan?
No.
Okay, TACO, Trump always chickens out. Okay, so it's the threat of massive trade tariffs, only for him to pull them back. So right now, the market's become accustomed to that, and they're saying, okay, Trump comes in hard, he makes big threats, but inevitably always backs out, and there's a much softer deal to be had, which has made the market brave again. And that's why we're seeing the valuations back where they were before the tariffs hit the tape. So once again, I think markets are becoming a little bit too complacent. We don't know what we don't know, but the point is there's not a lot of room or margin for surprise given where valuations sit.
Henry, we did, since our last discussion and what happened, we have had first quarter earnings, and I think first quarter earnings have been reasonable. I'd like your comments on those, particularly USA.
Look, if you go and just do a practical exercise on what the impact of tariffs, even in their current more diluted form, are on company margins in America, it's quite frightening. And what hasn't really moved are the market's expectations of earnings growth. So I think there is currently a detachment. The impact is greater on the smaller, sort of more middle economy business than it is the super giants like Facebook and Microsoft, for example, perhaps not Apple. You see that there's some big stories there. But remember, those smaller businesses are the clients of the super big tech companies. So there will always be a knock-on effect. While earnings reports have been good over the next 12 months, I have a suspicion that they won't be as good as people suspect.
And then, Henry, the big R word, recession. So let me just put this into context. If an economy grows in a quarter by 0.1 and the following quarter by 0.1, you're certainly not in recession. If the converse happens, 0.1 minus, 0.1 minus, you're technically in recession. However, the margin is so small between a plus 0.1 and a minus 0.1. Put some context on that.
Yeah, exactly. So I think the context really is that is just a definition, because ultimately there has to be a definition for everything. Should you get too caught up on what that definition is as an investor? Certainly not. What's far more important is the trajectory of the economy and by extension, US corporate earnings. And then on top of that, what value is the market placing on that growth? And right now, again, I'm just saying, I think there's a disconnect between what the market's pricing in and what company earnings might do. And that gap is a negative gap. And I don't think it's worth taking the risk.
So, Henry, if you've got a portfolio and heavy in profit, and obviously you've got to always be concerned about what do you do in the short term, if someone's got a 12, 18, 5-year time horizon, would you be liquidating some stocks and holding cash?
You know, Bryan, do you remember the other acronym, TINA? There is no alternative, that we were dealing with a couple of years back, where you were earning nothing on your cash and equities were expensive, but because interest rates were near zero, that was the only game in town. So in other words, there was no alternative. That was a difficult spot for us as money managers. But today we sit in a very different place, where actually you're earning a pretty healthy interest rate, aren't you, on your cash? And I think cash looks pretty good. You know, you can hold a cash-bearing ETF, interest-bearing ETF, earning anywhere from 4 to 5% in dollars. And I think the longer duration stuff, for example, the 20-year plus US Treasuries are looking interesting. If you look at that ETF TLT at $85, it's basically the cheapest it's been in decades. I think that might be an interesting place to play rather than in equities.
So let's now talk about the rand. I mean, we've seen the rand this year weaken against the pound and euro, but it's certainly strengthened significantly against the dollar. And, you know, is this likely? Is the dollar continuing? I mean, I think this plays very much into Trump's hands. It costs more for an American now to import. It's cheaper to buy from America. And certainly with tariffs coming in at some form, I mean, is the dollar going to likely continue to fall and the rand to continue to gain ground?
Yeah, it's always tricky to talk about rand strength, rand weakness, because it's a pair. So you can talk about it in either direction, and the terminology gets a little confusing. But what you're seeing now isn't so much rand strength as it is dollar weakness. The dollar is weakening against a number of different currencies around the world, not just the rand. And what are the reasons for that? Well, it's definitely the tariffs. It's the destabilization of the dollar. You've had massive inflation in the US. So you've had a debasement of the dollar in terms of purchasing power parity. And on top of that, I think that, you know, strategically, Trump's probably aiming for a weaker dollar to bolster domestic manufacturing in America's exports. So I think you can probably bet on a weaker dollar still from here over the next couple of years. And, you know, the extension of that is perceivably a stronger rand against the dollar.
Okay, so then let's get back to the third budget we just had. I mean, the most important thing is, do you believe sufficient funds have been allocated to support growth and ensure stability? And would you rather be investing in South African markets than maybe moving money offshore and investing internationally?
When you say budget, are you referring to our budget or theirs?
Our budget, our third budget.
Our budget. Okay, yeah, it's you know, do I think enough's being allocated to growth? Of course not. I haven't thought that for many years. I think, you know, our current budgeting policy is an absolute joke. Does that make is our stock market more attractive than the American market at this point? Probably, from a valuation perspective, not long term, but right now, today, valuation for valuation, expected return versus expected return. Yeah, I'd probably be more biased towards SA versus the US now than I would normally be. That doesn't mean I take all your money out of America and put it in South Africa. It just means if it's normally 80-20, perhaps now I'll be 60-40.
Yeah, but Henry, I just don't understand something. If our unemployment rate's running officially at around about 32-33%, and there's a whole lot of other comments that it's probably running closer to 40%, when you compare that to world unemployment rates and the top countries in the world around about the 5%. So consumers have less money available. We've seen that. We've seen working South Africans draw money under the two-pot system from the pension funds. We've had a slight salary. We've had a 0.25% interest rate cut in last week, but at the same time we've got a new levy coming in on petrol in terms of the petrol price. Where South Africans where are people going to find money to spend on South African companies? So is there a different focus on where you'd be investing in South Africa?
Yeah, so remember, the South African stock market is very, very different in constitution to the American market. The American stock market is very much geared towards the American consumer. 70% of the GDP is made up of consumption expenditure. In South Africa, it's very different. The market, basically, it's a bunch of miners and commodity producers and naspers and a lot of businesses which actually benefit from rand weakness rather than rand strength. So it's not a market that's driven by domestic factors. Part of it is, but a big part of it isn't. So the South African consumer is not in a good place. You and I have spoken about this for a long time. Doesn't mean that there are no opportunities on the South African stock market.
Well, something one has to, because, if we think about the many South Africans certainly who've gone offshore, probably 85 to 90% of offshore monies for long-term growth is now being allocated into global markets. Let's understand that how will companies benefit from a weaker dollar in the USA with earnings that they earn in different currencies, because that must translate to better profits in those companies when reporting in dollars?
Yeah, for sure. So you've got the translation effect of foreign earnings. That's certainly positive. But I think the real benefit is that American exports become cheaper. And hopefully, I suppose what Trump's hoping for is this reignition of middle America, where your small to kind of medium enterprise becomes more competitive on a global level. And that can be very good for the market. Yeah. I suppose, yeah.
And Henry, any views on grey listing? Can you see us moving out of that? Can you see us coming off that list?
Yeah, I can. Give it another 12 months. I think we're making some progress there.
Okay, but the talk is we're going to come off in September, August, September. You're not seeing that?
Yeah, no, it's. I think your view is the same as mine. It could happen sooner than that. It doesn't. I don't think it has huge ramifications for our stock market, though. So I wouldn't expect kind of a bump there.
Okay, well, Henry, I've got quite a lot of emails to get through with you. We're going to take a short break. Stay tuned, and we'll be back shortly.